Okay, hi. Today we be learning about interest rates and rates of return. And this chapter covers about how to calculate present values and future values. And we also try to explain the relationship between yield to maturity on the bond and its price, and distinguish among different debt instruments and understand how their prices are determined. Explain the difference between interest rates and rates of return. Also, the difference between nominal interest rate and interest rate. So we just going to move on and try to understand how treasury bonds are risky investment. The thing is that treasury bonds are a risky investment because of the interest rate increase, instability of the interest rate. The expectation of high future inflation would lower the prices of bonds as a result of higher interest rate on those bonds. So the issue now is that some investment analysis argue that very low interest rate on some long-term bonds make them risky investment. Okay, and we would want to know, why do interest rates and the prices of financial security move in opposite direction? It's either this is increasing and this is low, and this is low and the other is increasing. Now we just first of all try to know how to calculate present values and future values. And interest rate on first of all, let's see how the interest rate on a loan should cover the opportunity cost. As we all know, opportunity cost is the next available alternative which you didn't choose. Okay, now for you to be able to cover for the opportunity cost of that next available choice you didn't go for, first of all, the interest rate has to compensate for the inflation. Okay, compensate for the default risk and compensate for the opportunity cost. When we talk about inflation, it means the rise in prices. Okay, so compensation for inflation means that the interest rate should be able to cover for the payments even if the prices are rising, and should be able to because the payments received will buy fewer goods and services, so the interest rate should be able to compensate for the inflation. Now, on the aspect of compensating for default risk, the borrower might default on the loan. Not everyone know how to repay back their loans. So the interest rate should be able to cover for that in case the defaulter, or the person that has the loan, okay, is not able to pay back. Then we also have compensation for the opportunity cost of waiting. That wait time period you have to wait, the interest rate should be able to cover for it too. Now we're going to look at financial transaction, how its involvements in involved in payments in the future. The importance of interest rate comes from the fact that most financial transaction involve payments in the future. you know anything that sometimes yeah, anything that has to do with loan, it's not like the loan is going to be paid more. The longer the loan, the longer you're going to pay the interest rate. Usually they give you, this is the interest rate for so period of time, right? So for the longer the time, the worth of the money's value, because you're going to, it's calculated based on the interest rate when eh, when you are paying back, right? The loan, the interest rate pays for the period, like all I've said in the previous slide. So the interest rate provides like a link between the financial present and the financial future, which talks about the compensation of you mean you're going to wait for a period of time before you get the loan back, and uh, also you going to also, or the person that has the loan, we also have to pay for the use of the loan for the period of time the loan is being unpaid. Now we're going to look at future value and also look at we're going to look at compounding and discounting. When we say compound, it's actually a debt instrument that requires multiple payments of interest on a regular basis. It could be annually, it will be quarterly. This is just based on the agreement, okay, and the payment of the face value at maturity. So compounding and discounting are different. Discounting is the process of actually determining the present value of fund that will be paid or received in the future. So this for compounding, this is it's actually involves this is the formula. We have the principal times the one plus the interest for the number of years we give you the future value, okay. Okay, n is for the number of years, and the other n, it's then you will have at the end of n years, I mean the period of time, it could be 2 3 years as the case may be. Now the first one is also the future value. You see, for this one, I mean this one is just for 1 year period. If you calculate, if the year is setting, then for this it's for when the number of years is not actually setting. It could be any number of years. Okay, now we're going to look at this example. Okay, look at, suppose you are considering investing $1,000 in one of the following bank CDs. Okay, then first CD, it's we pay an interest rate of 4% per year for 3 years, and the second one we pay 8% the first year, which is 1% the second year, and 1% the third year. Okay, if you look at this, okay, the compound and discounting, okay, these are the formulas. Okay, this is a formula. So moving on, we're going to see how this is calculated. It just equates this data, the data given, the numbers, which is 1000, and we also have 4%, and we also have the number of years. This is the principal, this is the rate, and this is the end. Okay, now, so like we have 1000 interest and 3 years. If you multiply this, you're going to get this. This is actually easy to do. Then if you are going to calculate the future value of your investment with the second CD, you know the second one was that there is 8% of the first year, and 1% the second year, and 1% the third year. So how is this going to be done? You see, this we have to be 1000. This is the first year, this is the second year, and this is the third year. Okay, and we have, if you multiply all of this together, you're going to get this. So how do you make your choice? For you to decide, you choose the investment with the highest future value. The future value for this is the highest. I mean, if you are going to calculate the future value of investments with the first CD, which is 4% rate, 3 years, and 1000, you're going to it's going to be more profitable. You should choose the investment with the highest future value. So you should choose the first CD. This is 1124, 1124, and this one is 1101. Okay. Pay an interest of 8%. The first year 1%, the second year, and they pay an interest rate of 8%. The first year 1%, the second year, and 1% the third year. And this one is just to pay the interest of 4% per year for 3 years. Okay. So we're going to move on. I guess you understand that. So let's move on. So an example of discounting: funds in the future are worth less than funds in the present. means they have lesser value than the fund in the present, because over time prices just increase. These days things are so expensive, so they have to be reduced or discounted to find their present value. So present value is the value today of funds that will be received in the future. And this has to do with when we tell you time value of money. Time value, it's the way that the value of a payment changes depending on when the payment is received. The payment received now is different from the payment you're going to receive in few years time. Even in reality, people years before now, people earn less now and they were able to do a lot more compared to people earning so much now and they're doing less. So let's look, how does these things happen? So look at this. Discounting is the process of finding the present value of funds that will be received in the future. You can actually compound, you can actually calculate this. This is the formula for compounding, which is the present value, and this is the for discounting. Is present value times the 1 plus 1 I, which is the interest in number of years. Okay, anywhere you see n, it's number of years, and anywhere you see I, it's interest rate. Okay, so we're just going to look if there's an example. Okay, now first of all, some important points you have to know about discounting. Present value is also known as present discounted value. Present discounted value. Okay, the further in the future a payment is to be received, the smaller is present value. Means the farther it is, the present value now will be smaller compared to the more the years that is to be received. Then the higher the interest rate used to discount future payments, the smaller the present value of the payment. And the present value of a series of future payment is simply the sum of the discounted value of each individual payment. Okay, this is it. We have present value of a 1,000 payment to be received. This is 1,000 payment, right? Interest rate at 1%. Okay, first, these are the interest rates. This is for 1 year, this is for 5 years time, and this is for 50 years time, and this is for 30 years time. 1% of 1,000 in 1 year's time is this, 5 years time is this, and just like that. If you look at it, it's reducing. You seeing it? It's reducing from 990 to 951 to 861 to 4. Now if you look at it for 2%, it's same, 980, 905, 743, 550 is actually reducing. So for others, the first years are bigger. So this explains this, that the further in the future value payment is to be received, the smaller is a present value. So if you look at this, the present value of it in 1 year's time is way bigger than the present value of the 5 years time. Just like this, at 5 years time, it's bigger than in 50 years time. Now, at an interest rate of 5%, a 1,000 payment has a present value of 952. Okay, in 1 year, but only 231 in 30 years. You see, 231 in 30 years. So let's look at the last point. Okay, suppose the interest rate is 10%. Okay, and you will be paid 1,000 in 1 year and another 1,000 in 5 years. Then the present value of both payment is 902 plus 620 equals to 1,000. This is it. Okay, this is what it's talking about. Okay, so this explains all of this, that present value, the further in the future payment, the smaller the present value. The higher the interest rate used to discount future payment, the smaller the present value of the payment. Okay, the more the higher interest rate. Okay, and then the present value, okay, which is point number 4, the present value of a series of future payments is simply the sum of discounted value of each individual payment. So we're going to look at another example of the value for a college education. At age 22, it's 7. Okay, the following data are the national earnings of college graduates over high school graduates by age. Okay, Age 22, this is it. Age 23, they all get almost same for age 22 and age 23. Age 24 and 25 get same. So now, what is the present value of a college education from ages 22 to 25? Assume an interest rate of 5%. So if you want to do this, we go back to the formula which I already gave here, which was already stated here, which is the present value and for future value, how to get the future value and for this. Okay, now let's go and see how this is done. So this is it, solving the problem, which is this slide. We're going to try to answer A now. So this one, review the chapter material. Okay, answer part A by using the data given to calculate the PV of a college education. We already know the formula, right? Which is present value. Okay, let's see if we can take it out from here. Okay, this one, present value times multiplied by 1 plus in, just like that. So is they ask for 5 years, isn't it? So we're going to do this 1 2 3 4. Okay, this is the present value. This is it for 7,200 from ages to, so it's the same, right? 22 to 25. What is the present value of the college education from ages 22 to 25? Assume an interest rate of 5%. So let's say they said 5%, right? So if you say 5%, 5 divided by 100, you get this one, which it's a 0.005, okay, for second year, third year, and fourth year, right? Yes. So they said for if you look at it, they said from ages 22 to 25, from 22 to, so this one 7,200, and for this 7,300. So that is why we have 7,200 here and 7,300 here. So if you add this up, I mean you calculate this with your calculator, you're going to get this one. Okay, ensure you follow your board mass, your basic mass, to follow the board mass rule, and you do this, you get your answer. Now let's look at step 3. Answer part B by considering how to calculate the present value of a college education through the normal retirement age of 67. So in this, you should consider the earthly cost of attending college, which is the tuitions and books. Okay, and you should also the opportunity cost of attending college. Okay, and also the income or the specific occupation you intend to enter after graduation. All of this you have to put into consideration. So this council lets you compare financial assets. So the price of an asset is determined by adding up all the present value of all the payments from the sellers to buyers. So that is it for this question. Okay, and for A, and for question number A. Okay, for question number B, it's suppose you are 18 years old. Explain how you calculate the present value of a college education to make a decision about whether to take a job immediately after graduating from high school or to attend college and then work at age 22. So this is the way you should answer question B. Okay, so don't let the you should consider all of this to answer question B. Okay, now let's move on. We're going to look at the difference between debt instruments and understand how their prices are determined. Now, for debt instrument and their prices, the price of a financial asset is equal to the present value of the payments to be received from owning it. Now, what are debt instruments? They are just methods of financing debts. It will be through fixed payment loans, coupon bonds, just normal simple loans. Okay, They are also known as credit market instruments or fixed income assets. Then we could also look we should also look at equity. Equity is a claim of ownership. I mean, part ownership of a firm. It could be by common stocks or common stocks which are issued by the corporation, like shares. Okay, shares. We have, for shares we have preference and ordinary shares. So we have categories of debt instruments. We have simple loans, we have discount bonds, we have coupon bonds, we have fixed payment loans. Now the difference, these are all of the difference. We're going to try and look at all of the difference between of all these categories of debt instruments. For simple loan, they are debt instruments which the borrower receives from the lender an amount called the principal and agrees to repay the lender the principal plus interest in a specific date when the loans mature. This is a very common one. Okay, you take money from the bank and you and you pay the lender the principal plus the interest on a specific day. It could be 1 year, 6 months, 3 months. You pay all of this. Okay, like the example we have here. Okay, Nate actually took a loan from the Bank of America, for a 1 year period. Okay, the principal, it's the amount he collected, which is the principal money, the loan is 10,000, and in the end of the 1 year period he paid 11,000. So for what interest rate? This is the interest rate. Okay, at what? At 10%. At 10%. So at 10%, for that 1 year period you get 11,000. So we're going to look at discount bond. This is different from the simple loan. Okay, it's a debt instrument in which the borrower repays the amount of the loan in a single payment at maturity, but receive less than the face value of the bond initially. The bond value, the face value is 9,000, and when you want to pay back, you pay 10,000. Okay, this is called a discount bond, which is, and it's the accrued, okay, $909. Okay, for the year. So therefore the interest rate is, how to get the interest rate, you say the $909. Okay, the 10,000 which you'll be repaying back minus the face value of 9,000, it will give you $909. And the $909 you divide by the face value. Okay, which is 9,091. Okay, and you get the percentage, which is also 10%. We also have the coupon bonds. Coupon bonds are debt instruments that requires multiple repayments of feature on a regular basis. It's like you servicing the loan and a payment of the face value at maturity. You get the loan, let's say same 10,000 for example. Okay, 10,000. Okay, let's say 10,000, and the interest, it's you have to pay like 200 monthly on the loan, like you servicing the loan. This is what you pay. Then at maturity, which is for the 1 year period, you pay the you pay the 9,000 or 10,000 back. You pay it back. You pay the principal amount back. Now we have terminology of coupon bonds. It has face value, it has coupon rate, it has current yield. These are all the terminology that are used with coupon bond. The face value is the amount to be repaid by the bond issuer, which is the borrower, at maturity. The coupon, it's the annual fixed dollar amount of interest paid by the issuer of the bond to the buyer. And we have coupon rate, which is the value of the coupon expressed as a percentage of the par value of the bond. And we have the current yield, which is the value of the coupon expressed as a percentage of the current price. Okay, how does coupon bonds work? This is a description, though I just explained it. Let's use this to explain further. Now we have this, okay. IBM received 1,000 from coupon bond, okay. See, they're going to pay, it's going to be for like 30 years period. We have 1 year, 2 years, 3 years, and all the blah blah years till 30 years time. But they have to pay $50 every year for 30-year period, and at the end of the 30-year period, they have to pay the principal loan, the principal amount, which was the 1,000 they had initially borrowed from the first time they took up the loan. So maturity is the length of the time before the bond expires and the issuer makes the face value payment to the buyer. The example is just this IBM coupon bond, okay. This kind of loan is good. Usually you can get it for a long period. It can only be it can only be better, or it can only be the best if there's consistent income to make the there's consistent income to service the loan. Like you can see, there's this loan service of always paying $50 yearly on the on the 1,000 for the period of 30 years, okay, at 10%, okay. 10% of 1,000, I think, right? 10% of 1,000, you get $50. So we're going to look at a fixed payment loan. Is a debt instrument that requires the borrower to make regular periodic payments of principal and interest to the lender. This one is not just you paying the interest, okay. You're not paying the interest, but you're going to pay some amount of the principal amount, the principal amount alongside with the interest for a period of time, for the periods of the agreed term. Okay, like this one, I think it's for I think this is let's see, this is dollar, right? Okay, now example, you are repaying $10,000 for a 10-year student loan. Okay, for those students that actually take up students loan to fund themselves while in the school, and the interest rate is 4.6% interest rate, so your monthly payment is approximately 104, because you're not only going to be paying the interest rate, but you're going to pay a little part of the principal loan, the capital. You're going to pay a little part of this, okay, alongside with the monthly interest. So for a span of 10 period, so you're going to be paying $104. Now how do you do that? Is you look for 4.6%, 4.6% of this, okay. If you get 406% of this, yeah, so you're going to be making this payment of 104, 4.6 of 104 monthly. If you calculate this at the end of the 10-year period, you would have paid all of this money, including the accrued interest. Now Compounding and discounting helps students understand the consequence of low option. This is why when you are being admitted into school for countries that do offer students loan, they actually make you understand how these loans dey work. Compounding and discounting, how they work and how you are expected to pay back. Usually they give you the options of which method or way you intend to make your payment by. It could be the fixed payment loan or the coupon bonds. Okay, now the compound and discounting helps you to understand the consequence of loan options. Not making interest payment while in college. While you stay in college, you will not make the interest payment. The unpaid interest is added to the loan principal, so the monthly payments in the payback period would increase. They extended the payback period from 10 years to 25 years. Each monthly payment decreases, but since the principal is paid down more slowly, the total interest payment will increase. So this is how it works. Now let's move on. Now let's look at in your interest rate and student loan. You make no payment while in school. So for this whole period, you're going to make no payment. Amount of loan is 20,000. The interest rate is 4.53%. 4.53%. The interest you pay is $3,000. Okay, and your loan principal is 23,624. 10-year payback period, monthly payment rises from 208 to 245. Now if you're going to look at the option of payback period of 10 years, this is the loan, this is what you're going to be paying, and this is your interest you pay, and your loan principal will beat this. Okay, and you're going to pay a total of this. Then we have payback period of 25 years. Okay, you have $20,000. You have your loan interest rate of 4.53, and you have your interest you pay at 30,000. Okay, and you have your loan principal is 33,000, and your monthly payment is going to be this. So if you look at this, the monthly payment which has the less and your loan principal is going to be bigger, which is 33, and for this it's going to be 24, and for this which you have to pay between 208 to 245 is going to be this. Now we're going to usually that brings me by usually the banks that gives these students loan, they actually advise the students on which the fee best suit them at that point in time. Okay, like some probably go for this 10 years pay period, and some will go for the payback period of 25 years. Yes, 25 years you have more time to pay back, and you have more time to pay less. I mean, you're going to be paying less, and you have longer payback period, but then the money is going to be bigger than if you decide to go for a 10 years period payback, and you're going to be paying $208. And look at this. Okay, you will make no payment while in school. You're not going to make any payment. 10-year payback period, monthly payment rises from 208 to 245. Okay, okay, for this one, if you are in school, you make no payment, it's going to rise anyway. And if you are able to pay, maybe some they are, which is very rare, it's most not possible, because if many of the students, if you have this money, you probably not go for the loan. But if you have the means to pay back at this time while still in school, you see how small you're going to pay. All right, your loan principal, I mean the interest paid at the interest going to be paid is very small compared to this of 4,000 and this of 30,000. But if you decide to wait for 10 years period and 25 years period, you're going to pay more, and this will be your loan principal at the end of it. So we're going to look at the learning objective of knowing the relationship between the yield to maturity on the bond and its price. Now, bond prices and yield to maturity can be, this means consider a coupon bond with interest 6%, future value $1,000, and the number of years 5 years, and the price of the bond, which is P, is the sum of the present value of 6 payments. This is it. Formula. Okay, 6%. Okay, and this is it. We have okay, now the price of the bond is the sum of the present value of 6 payments. 1, 2, 3, 4, 5, 6. Okay, and this for a bond that makes coupon payments and mature in n years. Okay, this is it. Now we're going to look at yield to maturity. Yield to maturity is the interest rate that makes the present value of the payments from an asset equal to the asset price today. The interest rate on financial assets for financial market participants, we could be, let's say for example, simple loans like yields to maturity on other debt instruments. By simple loans, we could be like this 10,000 loan, for example. For a 10,000 loan, required to pay 11,000 in 1 year, and we have this one, 10,000 plus 1,000 for 1 year period, 1 plus interest. Solving for I, you have to solve for this I to get it. So we have 11,000 minus 10, then we get this, okay, or 10%, because sometimes the interest rate is not given, which is the I, so you have to solve for the I, which is interest rate. To get for the interest rate, you have to subtract. We've done this in the earlier slide. Okay, so you just deduct the required amount to be paid minus the given amount, okay, which is 10,000, divided by the given amount, you get the percentage. Okay, please don't forget this, because sometimes you see questions and the interest rate is not given. Sometimes it could even be the one of the information will be missing, and you are expected to calculate for it. Now let's consider discount bonds in when for a 10,000 1 year discount bond with a value of with a today value of 9,200. Value today, which is equals to present value of future payments, which is 9,200, and this. So to solve for interest for this, you're going to still get this for discount bonds. Okay, so a 1 year discount bond that sells for P with face value, the yield to maturity is interest, okay, future value minus the payments all over the payment. Now what about for fixed payment loans? For a 10,000 loan with an annual payment of 12,731, we say value today is present value of future payments, okay, 10,000, sorry, 100,000, okay, this 12,000, okay, like this for say 20, right? Now for a fixed payment loan with fixed payment, future payment and a maturity of n years, the equation is loan value, okay, future payment plus this and this is the formula for it. Then we also have perpetuities. A perpetuity does not mature. The price of a coupon bond that pays an infinite number of coupons equals P, which is equals to C all over 1. So now for a perpetuity with a coupon of $25 and a price of 500, has a yield to maturity of interest rate, which is $25 all over this $500, and you get this of percentage. To get the percentage, the interest rate. So these are different examples, okay, and they all have different equations that you would use to calculate the yield to maturity. For this is a simple business loan for 500 that requires a payment of 700 for 4 years. So for this, to get the formula, we already did, which is this one. Oh, sorry, and this one. Okay, you use this formula. Okay, hopefully, okay, let's see this one. Okay, so it's going to be for the simple business, which is for this. Then for this, you also this you should try your hands trying to do it. Okay, on your way, you try and practice with these ones and try to see if you'll be able to get the interest. If you look at it, the interest rates are not given. So just like the way they did the examples, you can solve and get for the interest rate. So let's move on. Now we're going to look at solving the, sorry, we're going to look at another example, which is this one is an example for yield to maturity for the debt instruments of a simple loan for 500,000. Oh, good. So these ones I said you should try. These are the way they've done it, okay, and you'll be able to solve them and you get your answers. They already done here for you. Okay, so let's move on to understand the inverse relationship between bond prices and bond yields. Now, what happens to bond prices when interest rate change? The thing first is that if new bonds are issued at the higher interest rates, the holders of existing bonds will want to adjust their bond prices. As the bond yield is higher, the bond's market price will fall below its face value. The prices go up, right? And the bonds market price will fall below its face value. So when interest rates rise, bond prices fall. You know, I said they go in opposite direction. So a capital gain occurs when the market price of an asset increases, and a capital loss is when the market price of an asset falls. Now, banks will, when this happen, usually banks reduce lending, just like in the financial crisis of 2007 and 2009 in the US. Okay, it was still, you probably read up. It's just a minor research you can do on your own for the financial crisis in 2007 2009. Now, for mortgage backed securities, borrowers began to default in their payment because of the so buyer required much higher yields to compensate for more default risks. You know, the interest rate was not be with the increase in interest rate, so a lot of mortgage backed, mortgage backed securities that has to do with houses, borrowers began to default on their payments, so buyers require much higher yields to compensate for more default risks. And by 2008, the prices of many mortgage backed security had declined by 50% or more. Higher yields on this security made lower prices, and in early 2009, US commercial bank has suffered losses of about 1 trillion on their investment. Okay, if interest rates on newly issued bonds rise, the prices of existing bonds will fall, and vice versa. Yeah, vice versa, in the sense that if the interest rates on existing bonds, okay, if it rises, new bonds will fall, and when the other falls, and the other will rise. So why is this happening? Because if interest rate rise, existing bonds issued with lower interest rate become less desirable to investors, and their prices will definitely fall. This is a relationship. This is why we say yields to maturity and bond prices moves in opposite direction. So let's look at secondary markets, arbitrage, and the law of one price. A trader buys and sells security to profit from small differences in prices. During this period, bonds prices fully adjust to changes in interest rate. There is an opportunity for arbitrage. Financial arbitrage is the process of buying and selling securities to profit from price changes over a period of time. Now, the prices of financial security at any given moment allow little opportunity for arbitrage profit, so that investors receive the same yields on comparable securities. And this is the law for one price. It follows, it's just a principle, and identical products should sell for the same price everywhere. It's usually the same price everywhere as far as they are same, they are identical, they are same products. Now let's look at treasury bonds and notes. Okay, this is for bond A. This is August 2023. Maturity, this is supposed to mature. This coupon bid, okay, these are all the function. Bond A matures on 31st 2023 and has a coupon rate of 2.5, so it pays 27.50 each year, 27.50 each year on its 1,000 face value. Now for bond A, 104.2560 means a price of 1,042.560 for this 1,000 face value bond. Okay, the bid. Okay, now the bid price is the sell price, which is this one. The ask price is the price to buy the bond, which is this. For a bond A, the bid price rose by 0.0320 from the previous day. This is this. If you look for the difference from this and this, you get this one. So for those of you that are interested in buying bonds, so you try follow the bond market. Okay, apply all of these concepts you are learning in this course to the bond market, and know which bonds are viable and the ones you probably not be going for. So now let's move on. We're going to look at treasury bonds. We're going to look at face value. Okay, we're going to see the current yield of bond A, which is 1,000 face value. Okay, and let's see. Okay, the current yield of bond A is well above the yield to maturity of 1.366%, and the current yield is not a good substitute for the yield to maturity for a short time to maturity, because it ignores the effect of expected capital gains or losses. So treasury bills are discounted bonds, not coupon bonds. This you should know about treasury bills. Treasury notes and bonds quote price, while treasury bills quote yield. The bid yield is the discount yield for sellers. The ask yield is for buyers. The last profit margin is the difference between the ask and the bid yield. And the yield to maturity, which is the last column, YLD, is useful for comparing investment. Use it to compare investment. Okay, we move on, and we're going to look at bond B. Bond B is for Apple Incorporation, right? A bond rating shows the likelihood that the firm will default on the bond. Prices are quoted in decimals. Let's see. They said the prices, this is the symbol for it, this is the coupon, and last sale price. Okay, now the last time this Apple bond was traded that day, it sold for a price of 1,000. Okay, last sale price 1,006.821. 106. Okay, I think this is 106.821. So we'll from this you'll be able to tell about the bonds. Okay, so the bond with default. Okay, now let's move on. We're going to look at difference between interest rates and rates of return. Return is the security total earnings. For a bond, it returns it's the coupon payment plus the change in its price, and the rate of return is the return on the security as a percentage of the initial price. Now arrow equals the coupon. I mean, I'm talking about a bond. The arrow equals coupon payment plus the change in price of a bond divided by initial price. So this is it. This is the arrow. Okay, and formula: a bond with 1,000 face value and a coupon rate of 5%. And this is it. You say coupon plus capital gain, and capital gain is given if the end price is 1,169. Excuse me. Then the rate of return for the year is this. So if the end of fair price is 864.9, then the rate of 864.09, then the rate of return for the year is this one. That is this $50 minus the surprise 135.91 divided by 1,000. Excuse me. So which is equals to this, and you get this. This is the general equation for it, and this you must know that for the current yield the calculation uses the initial price, and if you sell the bond you have a realized capital gain or loss. Okay, capital gain or loss. Okay, gain, loss. Okay, now look, now we have the current yield and the yield to maturity ignore capital gain or loss, so they may not be good indicator to the rate of return. So we're going to see interest rates risk and maturity. Now what is interest rate risk? Is the risk that price of a financial asset will fluctuate in response to changes in market interest rate. It's bonds with fewer years to maturity will be less affected by change in market interest rate, and we have an example here. Okay, the effect of maturing on interest rates during the first year of owning a bond when the interest rate rises from 5% to 7%. 5%. Okay, this was the initial price at the end of the year. Okay, and rate of capital gain or loss, rate of return during the year. So the table shows that the longer the maturity of your bond, the lower your return after 1 year of holding the bond. So the longer, the more is prone to be affected by the change of the interest rate. So the years of maturity, this is 1 year 5%, but by second year, which is at 5%, still 1,000. Current yield, okay, 10 years, 20 years, 15 years. Price at the end of the year, see 1,000. If this is for 5%, okay, if it's going to be 2 years, see it's reducing. The longer, the smaller the yield at the end of the year for the year period. 50 years is already way far less from the earlier years. Okay, and this is how it's reducing. Initially there was no loss, and over time the loss increase. Okay, we move on. We're going to see how much interest rate risk do investor in treasury bonds face. Although treasury bonds have no default risks, as long-term bonds they have significant interest rate. Now on the previous slide shows that the longer the maturity of a bond, the lower your return. Okay, that we already talked about. Year of owning the bond, it's minus 51.5%. We're going to go to explain the difference between nominal interest rate and real interest rate. For nominal interest rates, there are interest rates that are not adjusted for changes in purchasing power. And real interest are interest rates that are adjusted for changes in purchasing power. Why do they adjust? Because lenders and borrowers don't know what the actual real interest rate will be during the period of a loan. They must estimate an expected real interest rate. Then the expected real interest rate equals the nominal interest rate minus the expected rate of inflation. Okay, this is the formula. Interest rate pi. Okay, we're going to see the meaning of this. Let's see. If the inflation rate is greater than the expected inflation rate, less than expected inflation, the real interest rate will be less than the expected real interest rate. And borrowers will gain and lenders will lose. Okay, and if it is less than the expected interest rate, the real interest rate will be greater than the expected real interest rate. And this time around, the borrowers will lose and the lenders will gain. Now this is how it is. We have nominal interest rate, real interest rate, and expected real interest rate. And they are colors. Okay, the nominal interest rate is the interest rate on the 3-month US Treasury bills. The real interest rate, which is the nominal interest rate in blue minus the inflation rate as measured by changing the consumer price index. And the expected real interest rate is the nominal interest rate minus the expected rate of inflation as measured by a survey of professional forecasters. Sometimes when inflation is negative, it's possible for the nominal interest rate to be lower than the real interest rate. We also have deflation. We have just the way we have inflation, we also have deflation. If the inflation rate is negative, it means probably there is deflation. Okay, now we're going to look at another case study, tips as a percentage of all treasury securities. Okay, this is from 1997. Okay, the US Treasury has issued inflation index box called TIPS, Treasury Inflation Protection Securities, where an increasing percentage of all US Treasury securities until after if the share remained constant at 9%. Okay, this is it, constant for a while, and later it dropped to probably 7%, and there was a little instability. Rise, a little up, a little down, up. Okay, so with this, you should be able to answer the quick questions. At the beginning of the class, we try to know why do interest rate and the prices of financial security move in opposite direction. This is because the price of financial security equal the present value of the payments an investor will receive for owning the security. When interest rate rise, present value falls and vice versa. Okay, therefore interest rate and the prices of financial security should move in. Because of this, the interest rate and the prices of financial security move in opposite directions. So that is the end of today's class. I hope you all understood, and if you have any question, please don't hesitate to reach out. Thank you.